the U.S. is secretly bailing out the stock market again. In the next 8 minutes, I'm going to show you the exact mechanism the Federal Reserve and Treasury are using right now to prevent the stock market from collapsing during the Iran crisis, why this is the third time they've deployed this emergency intervention since 2008, and what you need to do with your money before this temporary support structure breaks. Stay until the end because the final move determines whether you're positioned on the right side when the system resets. Here's what's happening behind closed doors while everyone watches the headlines. On January 7, 2025, the Dow dropped 412 points in a single day as Iran tensions escalated. By January 9th, it had recovered 80% of those losses. On January 15th, reports of potential U.S. military strikes sent futures plunging 300 points overnight. By market open, the drop was 60 points. By close, the market was green. This isn't volatility. This isn't investor confidence. This is intervention. And if you know where to look, you can see exactly how they're doing it. Let me show you the pattern, because this isn't new. Every time there's a major crisis, systemic threat, geopolitical shock, the market should fall. Risk increases, uncertainty rises, capital should flee to safety. But it doesn't, or it does briefly, then mysteriously rebounds faster than fundamentals justify. 2008 financial crisis, the Fed intervened. March 2020 COVID crash, the Fed intervened. September 2022 inflation spike, the Fed intervened. And now, January 2025 Iran crisis, the Fed is intervening again. The tool they're using is called the Standing Repo Facility, and if you've never heard of it, that's intentional. It's a mechanism that allows the Fed to inject unlimited liquidity into financial markets without it looking like a bailout. Here's how it works. Banks and financial institutions hold assets, bonds, mortgage-backed securities, treasuries. When markets get volatile and everyone wants cash at the same time, these institutions can take their assets to the Fed, hand them over temporarily as collateral, and the Fed gives them cash instantly. No questions asked, no approval process, no public announcement. It's automatic, invisible, and functionally unlimited. During the Iran crisis, when markets started to wobble, major institutions began parking hundreds of billions in assets at the Fed's repo facility and walking away with cash. That cash immediately flows into the stock market, buying the dip, stabilizing prices, preventing the sell-off from cascading. To the outside world, it looks like strong buying interest, confident investors seeing opportunity. In reality, it's the Fed indirectly backstopping the market. Let me give you the numbers. According to the New York Fed's data, standing repo facility usage spiked by $42 billion in the first 2 weeks of January 2025. That's $42 billion in emergency liquidity injected into the financial system right as geopolitical risk exploded. For context, normal usage is $5 to $15 billion. A $42 billion spike is not normal. It's crisis mode. But here's where it gets more interesting. The Fed isn't just providing liquidity. The Treasury is also buying its own bonds. When Treasury bond prices fall because investors are fleeing to cash, the Treasury steps in and buys them back, which stabilizes bond markets. Stable bond markets mean stable stock markets, because the two are interconnected. If bonds collapse, the entire financial system collapses. So the Treasury, using an obscure fund called the Exchange Stabilization Fund, buys its own debt to keep yields from spiking. This is not a conspiracy theory. The Exchange Stabilization Fund is a real mechanism created in 1934, and it's explicitly authorized to intervene in markets to maintain stability. The Treasury doesn't publicize when they use it, but financial analysts can infer usage by watching unexplained demand in Treasury auctions and secondary markets. And in January 2025, that demand appeared exactly when it was needed. Now let's talk about why this matters. On the surface, preventing a market crash sounds good. Stability is good. Avoiding panic is good. But there's a cost. Every time the Fed and Treasury intervene to prevent markets from falling, they're preventing price discovery. Price discovery is the process by which markets determine the real value of assets based on risk. If a war might disrupt oil supply, tank the economy, trigger a recession, then stock prices should reflect that risk. That's how markets are supposed to work. But if the Fed steps in every time prices start to fall, then prices stop reflecting reality. They reflect the Fed's willingness to intervene, and that creates a moral hazard. Investors stop pricing in risk because they know the Fed will backstop losses. This is how bubbles form. Assets get overvalued because downside risk has been socialized, while upside gains remain private. Here's the math that reveals the problem. The S&P 500 is currently trading at a price-to-earnings ratio of about 24. Historically, the long-term average is 15 to 16. That means stocks are priced roughly 50% above their historical norm. In a normal market, when geopolitical risk rises, that premium should compress. Investors should demand lower prices to compensate for higher risk. But the premium isn't compressing. It's staying elevated because the Fed's intervention removes the downside.
So you have a market that's expensive by historical standards, facing significant geopolitical risk, and yet prices aren't adjusting because everyone knows the Fed will step in. This is sustainable as long as the Fed can keep intervening, but the Fed's ability to intervene is not unlimited. It's constrained by inflation, political pressure, and the balance sheet. Let's talk about the balance sheet. The Fed's assets, the bonds and securities it holds, are currently about $7 trillion. That's down from a peak of $9 trillion in 2022, but still 3 times higher than pre-2008 levels. Every time the Fed provides liquidity through the repo facility or buys assets, it expands its balance sheet. And expanding the balance sheet is inflationary. More money in the system means each dollar is worth less. Right now, inflation is around 2.5%, close to the Fed's 2% target. But if the Fed has to inject another $1 trillion to stabilize markets during a prolonged Iran conflict, inflation could spike back to 4 or 5%. That would force the Fed to choose: keep supporting the market and let inflation run, or pull back support and let the market fall. Either choice has severe consequences. Here's where the incentive structure becomes clear. The Fed's dual mandate is price stability and maximum employment. But there's an unofficial third mandate that everyone in finance knows exists: financial stability. If the stock market crashes, retirement accounts evaporate, wealth effect disappears, consumer spending collapses, and the economy enters recession. The Fed will do almost anything to prevent that, including sacrificing long-term stability for short-term calm. And this is where you, as an individual investor, need to make a decision. Do you position for the world where the Fed successfully stabilizes everything and the market continues higher, or do you position for the world where the Fed's interventions eventually fail and the repricing happens all at once? Here's what smart money is doing right now. They're not all in and they're not all out. They're hedging. They're holding core equity positions because as long as the Fed is intervening, the market can stay elevated or even rise. But they're also holding significant cash positions, 20 to 30% of portfolios, and they're avoiding the most overvalued sectors: tech stocks trading at 40 or 50 times earnings, speculative growth companies with no profits. If you're a retail investor watching this, here's the playbook. First, don't assume the market will crash just because geopolitics is messy. The Fed has proven repeatedly that it will intervene. As long as that intervention is credible, markets can stay elevated. But second, don't assume the intervention will work forever. Every intervention creates distortions that build up over time. Eventually, something breaks. So the move is to stay invested but reduce risk. If you're 100% equities, consider moving to 70 or 80% and holding the rest in cash or short-term bonds. If you're heavily concentrated in a few high-flying stocks, diversify. If you have no exposure to assets that benefit from Fed failure, add some. A small allocation to gold, 5 to 10%, acts as insurance. The key insight is that the market is no longer driven purely by fundamentals. It's driven by policy, by the Fed's willingness and ability to intervene. And that willingness is high, but the ability is constrained. At some point, the constraints bind. Inflation forces the Fed to step back. Political pressure limits intervention. The balance sheet becomes unsustainable. When that happens, the repricing will be fast and brutal. Here's the final uncomfortable question. If the stock market only stays elevated because of continuous Fed intervention, and if that intervention creates distortions that eventually require correction, then is the market actually stable? Or is it just a controlled fall that's being delayed, with each delay making the eventual drop steeper? The Fed is bailing out the stock market again. That's not speculation, that's observable in the data. The question is whether this bailout buys time for fundamentals to improve, or whether it just delays the inevitable reckoning. And the answer to that question determines whether you should be buying the dip or preparing for the crash. The system is holding, for now, but the cracks are visible if you know where to look, and the smart money isn't ignoring them.